business.
Managing risk, managing growth is a way of life for today's CEO. Today's businesses are exposed to the intrinsic risk of political, economic and market developments, both global and regional. How fast one manages to get back to business as usual in the event of a terror attack, fire or flood or any other major interruption will depend on the effectiveness of the risk mitigation plan one puts into use. Clearly, integrating risk management with business strategy is the need of the hour. That's a talking point. Joining me on the show is Mr. Alok Agarwal, ED, ICICI Lombard, Mr. Sunil Makharia, President Finance, Lupin, and Mr. Mrityunjay Kapoor, Partner, National Head of Risk Consulting, KPMG. Gentlemen, welcome to the show. According to Professor Richard Foster from Yale University, the lifespan of companies have decreased by 50 years. It was 67 years in 1920s. Today it is 15 years. Do you think these companies went belly up or became extinct because they did not put risk management in place?
I cannot say that all the companies that would have gone belly up would have been only because of the risk management, failure of risk management. But a good percentage of them, I'm sure, and more than half of them would have failed because of the proper risk management techniques. As you mentioned at the beginning of the show, that the lifespan of companies are coming down from 67 years to maybe 15 years today. So the main reason is that the market is very dynamic, and there are changes happening continuously, and changes are happening in this connected world. The changes that are happening anywhere else in the world is affecting India or any other country much more than it would have earlier. Let us take for example something, a climate change related event. Earlier we used to think that global warming is a global concept which may not affect us individually, and we have seen that global warming has resulted into many things, the most recent example being the Chennai flood. So if concentrated amount of water rainfall happening in a particular place over a 2-day or 3-day period can create havoc not only physically but also as far as business interruption is concerned, as far as business planning is concerned. So and there are many other incidents. If you look at the Paris incident that happened,
the terror attack,
terror attack that happened in Paris, that also is basically a reflection of some basic risk management problem that we have had over the years.
People have not been able to anticipate. You're saying that?
Yeah, people are not able to anticipate. People are not able to plan for these things the way it should be planned, because the attackers etc. are gaining more and more knowledge about the latest weaponry that is going around and latest techniques that are going around. So basically people need to be much more planned, need to have a mock exercises within the company or within the nation, within any part of a group of people, so that such things.
What you're saying, like a Boy Scout, you have to be ready all the time.
Yes.
Okay, Sunil, you want to add to that?
The managing the risk is the most important activity of the pharmaceutical company, I would say, because we deal with the medicines, we deal with the regulatory compliances. So compliances of the US FDA's, compliances of the other regulatory bodies, product qualities, they are the key most, and that's all part of the risk management practices. And let me tell you, and this is what has happened with some of the peers, some of the pharmaceutical company, how the music they are facing. If we cannot comply with the requirements, we cannot meet we cannot have the risk mitigations procedures in terms of the regulatory compliance, all these things, we cannot survive.
Okay, let me get KPMG's view here. Mrityunjay?
So absolutely agree. Now, difficult to comment whether all these companies had a risk management function in place, or is it only because of risk? But I think one important thing is that risk also is about opportunity, and whether or not these companies or a lot of the companies saw the changes that are happening in the environment, changes in terms of how the market is moving, how the consumers are moving, how the technology is changing, and embraced those changes to actually sort of take opportunity out of the risk. So I would put it more differently to say that while we can be extremely defensive about the whole risk management process to look at our operations and check what can go wrong, but one of the other aspects is really are we using risk management to take the risk and go in in those uncharted territories and actually develop newer products or markets.
Risk and growth are like two sides of the same coin. And there are two schools of thought here. They say a ship is safe in the harbor, but that is not the place where it ought to be. And RBI Governor Raghuram Rajan says, and I want your comment here, he says, not taking risk one does not understand is often the best form of risk management. So how do you balance this risk and growth?
See, any business that just the fundamentals of business is about taking risk and about harnessing the opportunity that a risk presents. So risk management is not just about being defensive and creating a protective layer of an organization, which traditionally we've come to believe in, and I think that's largely what is being done. It's also about creating a right framework to actually be out there in the marketplace to take those risks, or to, as you said, to sail the ship away from the harbor in the rough seas to become big. Risk management at the most can probably, if you look at a speeding car, it can possibly be the brake in that car, which gives you the mental ability or strength to know that if you're going too fast or if there's something wrong that's going to happen, you have the ability to stop or to change the course. And I think that's what really risk management as part of growth strategy or as part of a CEO's vision has to take the form.
Okay, let me get Alok. Alok, what I understand from an insurance company perspective, various surveys indicate that embedding a sound risk culture still is in infancy in India. 64% of non-financial companies have indicated that risk management rules and responsibilities are not formalized. Only 20% of the respondents said they have formally articulated risk appetite among their staff. There is a tendency to glorify firefighting but not put risk management in place. Do you see this changing from insurance company perspective point of view?
Yeah, I would say I am seeing this changing, but the pace is not fast enough that we would expect. Around 2-3 years back, when we started giving advice to companies on the risk management techniques that can be used, initially we found a lot of skepticism within the companies that we tried to market it to. But slowly companies have turned around, some because of sheer incidences that have happened in the past, and some because of the peer pressure that they are facing or some kind of a regulatory pressure that they might be facing, have come around, and we are seeing that increasingly at least large companies and some MNCs are moving towards the holistic risk management program. But having said that, I am not sure whether all the companies which are adopting the risk management framework are adopting it with their heart into it. Basically, it might have turned into a paper ticking exercises,
okay.
And some of it might be only to satisfy the board. It's a board presentation for that matter. But having said that, I must say that the culture is changing, and there are a few companies who are taking this seriously.
Do you see certain sectors more proactive here where risk management is concerned, and certain sectors are not?
So I would say financial services as a sector is the first to adopt this.
It's a given, yeah, it's given.
So because the amount of risk that they face is perhaps higher than others. But among manufacturing companies, we find that the traditional forms of risk management, which is safety and some kind of operational risk management, are the things that they are looking at. They are not looking at holistically the way we would expect them to, having grown to a particular size.
But post Lehman Brothers crisis, I thought both volatility and uncertainty must have put a lot of companies on guard. Or still the lessons not learnt?
I would say it has improved after Lehman Brothers crisis, the risk management function, but the complete lessons are not learnt, and the market is very dynamic. I would rather give a state example, something like a Chennai flood, which is a recent incident. We have had, India is a flood prone country, and every
extreme, flood and drought both together.
Yeah, both together. This last 2 years have been, we have had droughts, and last 2 years we have had 3 floods, one in Uttarakhand, the other in J&K, and this is the third one is in Chennai. Uttarakhand and J&K, luckily for us, was not an industrialized region. It was more human casualty, more economic losses, but there were large companies, few and far in between. Chennai, on the other hand, is a full-fledged city, and there are a lot of warehouses, e-commerce companies, even the airport was flooded, and there were aircrafts whose tail, where the water has entered.
But I was told in Chennai the insurance loss is something that 2,000 crore and the business loss something like 15,000 crore. Is that be the right number?
Yeah, it is. You are more or less right. 15,000 crores is the number, economic loss that would have happened, and business loss that we estimate today is somewhere between 1,500 and 2,000 crores.
So, which brings me to the question. So, how do you integrate risk management with business strategy? Are CEOs doing that today? Which is the topic of the day what we are doing. And in terms of percentage, how many companies are really doing it? Mrityunjay?
So, and I'll try and position it. As an organization keeps building, so when you look at startups and smaller organizations, it's inherent within the CEOs to, look at risks and manage it. And somewhere in their planning exercise, you will see, because they are very hands-on and they are managing the entire thing. So as companies are growing larger and bigger, I think this entire risk management process is possibly being siloed into a separate function. And how does it seamlessly work with the entire business planning exercise or the managing exercise? I think it's not being done as one would expect, because end of the day, when the strategy is being built out, there is also an element to identify what can go wrong and what are the imperatives of that going wrong. And secondly, what are the signals of change in the market which can be a risk from business operations or a continuity perspective, and how do you need to transform or redirect your business to those directions. So we don't see that as a significant sort of an input. It's more intuitive, because as business managers, you are supposed to be aware of risk and incorporate it in your doing of business, but tools, methodology, technique, getting the right input, data, all of those elements are critical while building this, and I think it still, a lot needs to be done for organizations to embrace it.
Okay, a lot needs to be done. Sunil, I want to get in. He said they operate in silos. One is the mandatory requirement. So, okay, you have one risk management department, is sitting some corner office and things like that. But in a pharma company, in the pharma sector, the risks are very different. So how do you all integrate your business strategy with risk? Because you could have US FDA saying you something, you could have counterfeit, you could have piracy, you could have various kinds of problems here.
Absolutely. No, first of all, I like to say this entire exercise should be driven right from the top. So I would say the CEO or the managing directors, they should drive this exercise, and that's what happens in our company. The message from the top to the bottom or to the shop floor is very clear. Don't take any shortcuts, whether in terms of the manufacturing process or in terms of the quality of the products and so and so. So it has to be an integrated exercise. If I further get into the further integrity, we need to identify the risk in terms of operational, strategic, compliance age, and sometimes what we do that as far as the compliances are concerned, it's a zero tolerance policy.
Yeah.
As far as product quality, it's a zero tolerance. So that's why we need to decide the appetite of every risk. Business is all about taking the risk, of course, but some of the areas where we will have to decide, yes, it will be the zero tolerance which we cannot afford. And thereafter then the adequate efforts should be done, or it is being done. And I'm not talking about in terms of to comply with the listing agreement requirement or to comply with the Companies Act requirement, but in a true sense or in a, I would say, in a sense, how we can mitigate the risk.
So Alok, should organization define its risk appetite and bring everybody on the same page? What would your advice be to the...
To begin with, the organization first define what are the risks that they have and then bring it on the table and have a discussion around it, that these are the risks that can be mitigated, these are the risks. If we try to mitigate, the cost is high enough which we can't afford at this point of time, but at least we are aware that today at this point of time these are the risks that we are taking, and we will be basically we have no mitigation tool as of today, and our business cannot afford to mitigate it today. The problem starts with that all the risks that we have in the organization are not put on the table. Even it might be in the head of certain business departments.
Yeah, okay.
It is not brought on the table with all the various stakeholders, right from the finance, accounts, risk department, business departments, and even the CEO, all of them coming on the same page as far as the various risks that are there in the organization. Then some of the risks which can be transferred to maybe an insurance company or some kind of a risk absorption company, and the other risks which are business risks and you have to take.
Sunil, as a finance man, when I talked about the quarterly pressure, when to hedge, when to punt, when to play safe, how does it happen in the pharma sector?
I would say here the concept of the maybe new company or the mature industry plays. The companies who are a little bit mature, who are in a position to sell their story to the investing communities, I don't think they get perturbed because of the quarterly pressures.
Okay.
They would accept, they would face it as and when it comes. But let me also add, since you asked as a finance man, foreign exchange risk. We're not talking about that.
Yeah.
That's again is a very, very important risk, and especially a company like ours where the 70% of the revenue comes from the international business.
So rupees weak, dollars strengthening, euro is falling, Chinese yuan is.
See the currencies of the developing countries like South Africa, Brazil, Mexico, the way in which they have weakened, and we have the presence in those countries. Those countries imports. Sometimes it may change the entire chemistry. Okay. So the take the forex position to forex position in terms of translation also, because we are supposed to present the consolidated results. All are the very key and important activity of the finance function in today's scenario.
Okay. Let me get Mrityunjay. How important it is for companies to invest in training, coaching, and mentoring to embed the risk management culture that is vital for an organization?
I think extremely important. Training in general, the entire culture that you need to build around risk management has to be driven through a training program, because otherwise it will not flow down into all the elements of an organization. So training is important. Mentoring is essential in terms of providing the right governance structure, the right values, the ethics that an organization follows, and I think it becomes an important part and parcel of embedding the risk culture throughout the organization. So be it an induction training, be it intervention trainings or regular trainings that are happening, there has to be a risk management element around it. So organizations like ourselves have significant risk management trainings that happen on a continuous basis. And similarly, I think even organizations like banks or organizations where there are critical information that they're dealing with have a lot of emphasis on training.
The risk of not taking risk, entrepreneur's instinct versus following the risk model, opportunity loss versus opportunity cost.
In my opinion, the risk of not taking a risk is higher than doing all the compliance. Compliance, of course, is a non-negotiable thing, but I would say risk of not taking a risk is a big risk in the today's environment. And as Mrityunjay said, there are a lot of established companies which have a fixed way of doing things and which need to challenge every day. And there are particular individuals who might get affected, who are the so-called day-to-day functionary of the companies. So it affects them personally. So it is very important that we challenge every day what we are doing, and from the entrepreneur point of view, he has to take newer and newer risks continuously in order to survive in the long run.
Sunil, your 30 seconds.
We acquired recently a company in Russia, Brazil, Mexico. Despite we know these countries have a certain inherent risk.
Yeah.
So in the business, we cannot escape from the risk. If we want to grow, definitely we'll have to be ready to face those things. Only thing, we need to have a right procedure, system, compliance mechanism to mitigate. Maybe not to 100% avoid, but to how to reduce. That's the thing, we need to have a proper systems. And that's why the right risk management practice is very important for any company.
Mrityunjay, final word for you.
Yeah, so I mean, if you don't take risk, then essentially there's no business. So you might as well shut shop eventually. So I think taking risk is critical. The risk management or risk functions are all support functions. They can't be overriding or decide how business is done, but they can direct you towards what risks one can take, what opportunities one can work out of, and more importantly, once the business owners or the entrepreneurs have taken those risks, how to manage those risks so that the business runs effectively. So the risk of not taking risk, in my view, is the highest, and that's the biggest risk.
Okay, gentlemen, thanks a lot for being on the show. It was a pleasure having all of you there. Thanks a lot.
Focus, ideate, innovate, enable.